We continue the subject of basic groups, and indeed we continue the subject of changes in ownership. There are 4 questions in a block that make up changes in ownership. And I'm going to just look to my left-hand side at my notes. It's top, toy, love and rock. And this is the second of 2 recordings that I'm making on changes in ownership. I decided to break this relatively big subject down into 2 recordings. Hopefully you've seen the other video, and if you haven't you should go back and see it. The other video, the first video on changes in ownership, introduced changes in ownership and recorded the first question called top. Now top, as you might remember, was an acquisition. In fact, it was a step acquisition, but more importantly it was an acquisition. Now an acquisition is a group thing. You remember there's 2 different points of view. There's the parental point of view and the group point of view. There's the parental point of view and there's the group point of view. The parental point of view is the purchase and selling of shares. Now, quite frankly, this is pretty much not examined at P2. When a parent buys some shares, the parent buys some shares. When a parent buys some more shares, the parent buys some more shares. When the parent sells some shares, the parent sells some shares. When the parent sells some more shares, the parent sells some more shares. Okay? That's the parental point of view. But we're looking at the group point of view. And the group point of view, as you might remember, is quite different. There is a threshold over which you must stride in order to take control. There is a threshold over which you must stride to lose control. And of course the threshold is 50% ownership of the voting equity, because it's 50% of the voting equity plus 1 vote, the majority of the voting equity, that gives you control through the ordinary or the majority resolution. Once you have an ordinary or majority resolution available to you, you can hire and fire directors, you can change the strategy, you can do what you like with the other entity, and therefore that entity becomes your subsidiary. So when you pass the threshold of 50%, you get control, and it's called an acquisition of a subsidiary. And when you go the other way, you go below 50% ownership of another entity. That is called a disposal, because you lose control. Now there's 4 exercises here. Now the reason there's 4 exercises is there's actually 4 things to talk about. The first exercise, top, as I've mentioned, was an acquisition, and that was an acquisition because we crossed the 50% threshold. The final exercise is called rock, and that goes back the other way. We lose control, and therefore we have a disposal. So rock is subsidiary disposal, and top is subsidiary acquisition. Now the other 2 in between are where you retain control of the subsidiary, but you as a parent get more or less ownership. Okay? So they're kind of 2 sides of the same coin, really. They are not just changes in ownership, they are purely changes in ownership. And I think the best way to get a feel for what's going to happen in these questions is to start the question and have a look at the story there. So I think what I'll do is I'll whack down the title before I go any further, then we'll talk it through and then we'll bash out the numbers and see how you feel about it. Okay, so the question is called toy, and the other question's called love. And in both of them we retain control of the other entity. Toy. At the year's start, Toy acquired 75% of Boy and therefore gained control. Therefore, Boy becomes the subsidiary. The fair value of the identifiable net assets of Boy at the point of acquisition was 180 million. The fair value of the NCI was 80 million at that point. The group has the policy of recognising the non-controlling interest at fair value. So we're going to use the 80 in calculating our goodwill, which is exactly what's required in part A. Excuse me. In the second part, in part B, at the year end, Toy acquires a further 5% of Boy for 24 million. Now, when you buy 5% on top of 75%, you as a parent end up with 80% ownership. So the ownership goes up from 75% to 80% ownership. So your ownership increases. So the controlling interest ownership increases. But what definitely doesn't increase is control. Control is an on-off switch. You either have it or you don't. And we have it. We have absolute control of the entity when we have 75%, and we have absolute control of the entity when we have 80%. So there is no acquisition. There is no subsidiary acquisition in Toy. There is purely a change in ownership. Well, if our ownership goes up from 75 to 80, if our ownership goes up, whose ownership goes down? Well, of course, the non-controlling interest goes down. The non-controlling interest goes down from 25% down to 20%. And that's what happens. There's a swap in ownership, in the equity. The two equity owners are us and them. Us, the controlling interest, and them, the non-controlling interest. We get a bit more, they get a bit less, and that's all that happens. That's enough talk, let's do it. So it says A, do goodwill first. So it's goodwill, fair value of consideration. Is representative of a 75% ownership. And costs us in the parent Toy 300 million. The fair value of the NCI at that time is 80. And the fair value of the net assets was what? The fair value of the identifiable net assets of Boy was 180. So we've got the fair value of goodwill at acquisition was 380 for the value of the business, 180 for the value of the net assets, so 200 million for the value of the goodwill at acquisition. Now, goodwill is slapped on the balance sheet and subject to an impairment review. The goodwill won't have changed over those 12 months unless it suffers an impairment, and in this case it doesn't, so it's still worth 200 at the year end, and that's when the transfer takes place. B, we're required to do the transfer from NCI and a reduction in the non-controlling interest. So the transfer from the NCI, first of all. Transfer from NCI. So the transfer from NCI is all about the NCI, which, if you remember, is 25%, 25% at the start of the year. And it's still 25% 12 months later, 25%. So we've got the NCI before the transfer, and the NCI after the transfer. And what we're required to calculate is this figure here, the the transfer to the CI, this figure here in the gap. Now, what we need is the NCI not at acquisition, but the NCI immediately before the transfer. We do that by using the roll forward technique. And the reason we need that is what we're going to say is that, looking at it from the NCI point of view, if the NCI are transferring from the NCI to the CI, then the NCI are transferring 5% of their 25%. Do you see that? So what we need to do is find out how big they are and then transfer a fifth of them from them to us. So the transfer is 5%. I think I'll put it in red, actually, bright red, just to illustrate that. It's 5% of the 25% that we want for that gap figure there, highlighted in blue. So that's the figure that we want. In order to get that, we need to have the size of the NCI before. And we're going to use, the examiner's favourite roll forward technique, which does work rather well in this case. So at acquisition, the size of the NCI was 80, and it will have grown because of the growth in the entity. Now, over the 12 months since the NCI came into existence, the entity has grown, and as the entity grows, it makes profits, and those profits are partly attributable to us and the parent, and partly attributable to the NCI. So 25% of the growth will belong to those guys, but we need to know how big the growth is. And I think it just tells you how big the growth is, if I remember rightly. It just says boy has made profits and grown by 20 million over the year. Easy enough, I guess. So 20 million is the growth, and of that growth of 20 million, 25% belongs to them, 5 belongs to them. So 85 is the size of the NCI immediately prior to the transfer. And what happens is, as the NCI goes from 25% down to 20%, it transfers 5% of its 25% to us. It transfers a fifth of itself to us. And a fifth of 85, rather cutely, is 17. And I think the remainder is 68. If my brain serves me right, but I'm not going to trust it. Here's my trusty Casio hidden in my pocket, so let's have a bash at that. So let's just, 85 is right, so divide that by 5. Oops, divide by 5. Gives us 17, multiply by 4, gives us 68. So 68 is left behind. We're not really interested in the 68. What we like is the 17, because that's going to come into the CI. And that is where the answer continues, where the question continues. Now, the question asks us for the reduction in the controlling interest, which sounds a little odd. So there's a reduction in the controlling interest, apparently, according to the requirement. But hang on, we've got transfer from NCI coming into the controlling interest, from the NCI is 17. Well, that's going to make the controlling interest grow by 17. So how is it that we have this heading, reduction in the controlling interest? Well, what's happening is not only is ownership transferring into the controlling interest, but the controlling interest is also shrinking because it's the parent that pays this cash payment of 24. Do you see the 24? At the year end, Toy acquires a further 5% of Boy. Toy acquires a further 5% of Boy for 24 million. That's us, that's the controlling interest. We spend that 24 million, and as we spend that 24 million, it makes us shrink. So the consideration is a shrinkage to the controlling interest, a shrinkage to the parental interest. And it's a figure of 24, and the net effect is 7. So that's the reduction. And that is the end of the answer. But it's not the end of my commentary. Now, the examiner, I can see no possibility whatsoever that he's going to ask this. And certainly there is absolutely no guidance in his useful article in the newsletter from February 2009, the newsletter that's mentioned at the top of the page in the Changes of Ownership introduction. Now, the examiner has given no indication that he's ever going to ask us for journals in this case. But when I've taught this in the past to live classes, I've often found that students actually benefit from having a look at these journals. And frankly, if I'm really honest, when I first looked at this subject myself, I wanted to know what the journals were. Now, this is just purely instructive, and it's certainly not something that should form part of your studies. But let's have a look at what the journals are that represent this -7. Well, the truth of the matter is there is no -7. There's two separate journals that give a -7. Now, IFRS 3, from which this has been derived, is frankly rubbish. It gives almost no guidance in any area, and certainly gives absolutely no guidance in this area. So exactly how the journals would pan out in real life, nobody really knows. But can I suggest that a solution might be this? Can I suggest that there should be a journal for the 17 and then a separate journal for the 24, and it would look like this? This is what seems to be implied by the International Financial Reporting Standard. So debit, credit. The 17 first of all, right? So the 17 is the reduction in this NCI, so it's debit to the NCI of 17, and it's going into the controlling interest. Now, the controlling interest is actually made up of 4 buckets. The 4 buckets at the bottom of the balance sheet are share capital, share premium, revaluation reserve, and retained earnings. Now, whilst there is no guidance whatsoever as to which bucket gets this 17 hit, it seems likely that it's going to be the retained earnings that get the benefit of the transfer in. And how does it work with the payment of the 24? Well, the payment of the 24 would result in a journal, right? A debit and a credit. The credit has to be to the bank because, you know, this 24 million is actually cash. Now, there is no specific guidance as to which equity bucket would get the hit of 24, but it appears to be implied by the IFRS that the bucket that gets the hit for the consideration should be the retained earnings. And now you see what I mean. We have a net effect of 7. And in fact, it's a reduction of 7. As we get a debit to retained earnings of 24, there's a compensating credit to the retained earnings of 17, but that still results in a net decrease of 7. Okay? And that's what's implied by the IFRS as regards changes in ownership once you have control. Once you have control and you get more ownership, there's a transfer from the NCI to the CI that results in these kind of journals. Now, going the other way, it should be an exact reflection of this. And the question is, love. So let's have a look at love. At the year's start, Love acquired 90% of RAT for 450 million. The fair value of the identifiable net assets of RAT at the point of acquisition was 380. The fair value of the NCI was 45. The group has the policy of recognising the non-controlling interest at fair value, and the requirement is goodwill. Okay. So here we go. So requirement A is goodwill. And try not to overload our brains too much. Let's just have a bash at this. So the fair value of consideration, which represents a 90% ownership. Costs us in the parent a consideration of 450. The fair value of the NCI at that time was 45, apparently. So the fair value of the business was 495, and that's 10% there. We compare that to the fair value of the net assets of the entire entity, which was 380. And that gives us a goodwill of how much? So that's, what did I say? 495 minus 380 is 115. Is 115 is the amount of goodwill at that point. Now, it's very tricky this, but I want you to do a sort of compare and contrast between love and toy. What we're going to do here when answering love is not going to make any sense, but it's going to get written, going to get marked correctly in the exam, and that's what it's all about, right? Reading on, beyond Part A, into Part B. At the year end, Love disposes of 10% of the equity of RAT for 55 million, and so reduces its ownership to 80%. RAT has made profits and grown by 20 million over the year, and therefore the carrying value of RAT is 400 million at the year end. Now, what would be a logical answer to this question, love? Well, what did we do in toy? Well, in toy, going back, the ownership percentage that we had was 75, going up to 80. Because our ownership was going up, the NCI was going down. It was going down from 25% to 20%. Now, it was deemed that the NCI was therefore transferring to us. Well, the NCI was transferring to us. And the way that we worked out how much the NCI transferred to us was simply by saying, well, if they've transferred 5% of their 25%, then they have transferred 1/5 of their ownership to us. That's what we did, isn't it? Now, if you apply the same logic to this, the transfers go in the other way. Our ownership starts with 90% and then goes down to 80%. So if our ownership goes down, their ownership goes up. If their ownership goes up, then we are transferring to them. So by the same logic, if we transfer 10% of our 90% to them, then surely we've transferred 1/9 of ourselves to them, right? Okay? I mean, if in the other one, they've transferred 5% of their 25%, and that was the answer to toy, then we have surely transferred 10% of our 90% in this case. All right? That's what would be logical. That's what makes sense. That is not what we're going to record. We're going to record the transfer of just a simple 10% of the whole business. Okay? It's mad, but that's what we're going to do. Okay, here we go. Oops. Just get rid of that. If I can... Oh, it's a bug of this thing. There we go. There we are. B. So we need to know how big the whole business is, and then we'll transfer just 10% of it. So the transfer, what's it called? Transfer to NCI. Transfer to NCI. You remember the previous one was the transfer from NCI, whereas this one is now the transfer to NCI. What you do is you measure the whole size of the sub at the point of transfer. What is the sub made up of? The sub is made up of goodwill, which you've just calculated, which is 115. And it's also made up of net assets. The net assets have grown, you might remember, at acquisition. When we took control, they were the size 380. And if you take a look at the question, they've grown by 20. Again, 20 on top of the 380 gives us 400. So that gives us a figure of 515. And therefore the transfer is deemed to be a simple 10% of this. £51.5. And that's the transfer. And it's horrible, isn't it, really? It doesn't really make any sense. If this method in love makes sense for love, why can't we apply it in toy? Why can't we go back and have a look at toy? Go and have a look at what we did do for toy. It's just gross. It's just grossing me out even thinking about it. When you look at toy, hopefully you can see it just to my left-hand side over here. We've got an NCI before of 85, and we're transferring a fifth of that, right? But why do we do that? Why don't we just find out how big the entity is and say we transfer 5% of the whole entity? If it's okay to transfer 10% of the whole entity in love, if it's okay to transfer 10% of the whole entity in love, then why can't we just transfer 5% of the whole entity in toy? The answer is quite simple. You are answering this question this way because this is how the examiner does it. Okay? How do we know this is how the examiner does it? Well, the examiner has written an article. He wrote this article in February 2009. It is in the newsletter, the students' newsletter, February 2009. And I am going to record a video working through that article. It will form part of your revision course. But obviously I've worked this article many, many times. And I know what it says there. And what it says there is, as your ownership goes up, you use one method for changes in ownership. As your ownership goes up, you use one method for transfers. But as your ownership goes down, you use a different one. And that's what it says. So that's what we're doing. So when you're transferring from the NCI to you, as your ownership goes up, what you do is you look at how much of the NCI is transferred by the NCI to you. But when you're transferring down, you just take the percentage of the whole business. So in the case of love, because the transfer percentage in going down from 90% down to 80% is 10%, you don't think to yourself, no, you don't think to yourself, right, 10% is 10% of the 90%. No. Because the examiner says you must do it a different way, you take 10% of the whole business. So 10% of the whole business, in this case, gives us 51.5. So that's going to transfer from us to them. And that's going to give rise to an increase in the controlling interest, apparently. So you have an increase in the controlling interest. First of all, you've got this transfer to the NCI. Which is 51.5. So you've got this transfer to the NCI, which is 51.5. But actually, that transfer to the NCI is a transfer from us in the controlling interest down to the NCI. So it's actually making the CI shrink. So the CI is fundamentally shrinking. So why do we have the word increase in controlling interest? Why do we have the phrase increase? Well, the answer is because the consideration is now coming in. Who is it that's actually selling this 10% ownership of shares? It's the parent, isn't it? It's us, it's love. At the year end, Love disposes of 10% of the equity for 55 million. That 55 million is flowing in, and it's going to make the controlling interest grow by 55 million. And therefore, the net effect is a small growth of 3.5, a small increase in the controlling interest. Again, this horrible subject is very badly covered by the International Financial Reporting Standard, and therefore it's impossible to know exactly what journals they intended, but this is what I interpret. And of course, they're an exact flip. They're a mirror image of the journals that you saw in the answer to the previous question, toy. So what did happen? There's two numbers to deal with, aren't there? There's the 51.5 and the 55. So those are the two separate things that result in the 3.5. So let's do the transfer to the NCI first of all. Well, the transfer to the NCI is going to go to the NCI. So that's credit to the NCI of 51.5. And it doesn't say exactly which equity bucket this transfer comes from, but it appears to mean the retained earnings. Of the group, 51.5. And of course that will make the retained earnings decrease. On the other side, the consideration comes into the bank, and it's real cash, and hits the bank to the tune of 55. And that inflow is transferred straight to equity. Which bucket? Well, again, I interpret it to mean retained earnings. This credit balance to retained earnings is good news to the tune of 55. And therefore, as this good news combines with the bad news, we get a net effect of plus 3.5, because the transfer out is smaller than the consideration flowing in. And that's what gives you the net increase in the controlling interest. I don't know if it's a tricky subject. Perhaps the word tricky is actually perfect. It's a very illogical subject. It's very messy. It's very philosophical. There's lots of thinking involved, but fundamentally, when it comes down to it, the only thing that's going to matter in the exam is whether you can do it. Now, if you feel you can do it already, then you can do it, and that's it. Game over. No extra work required. If you feel completely comfortable that you can bash this out in the exam under any circumstances, then that's fine. If you're feeling a little bit uncomfortable, then please review these two questions. And frankly, if I'm honest, I think it is worth it, because they're going to get examined probably regularly. Now, in order to get comfortable, you have to just accustom yourself to the idea that this doesn't really make sense. Toy and love should be two sides of the one coin. There should be a certain logic that flows from toy to love. Whatever we do in love, that's what we do in toy. Whatever we do in toy, that's what we do in love. Because fundamentally, they're the same thing. One, the ownership is going up, and we're keeping control. The other, the ownership is going down, but we're keeping control. The idea within these two questions is that the answer should be identical in its principle. But as you can see from what I've been saying here and what I'm struggling with now, it isn't. And the reason that the answer to toy and love are not two sides of the same coin, they're not mirror images, is because the examiner does the answer to love, I think. He does the answer to love in a way that is inconsistent with the answer to toy. He's the examiner. He's got the red pen. It's up to him, and therefore you follow his method. Follow his method. Do it the way that I've done it in love. But in order to make yourself comfortable, work this vid a couple of times. But what I'm really working myself round to is there's a really substantial answer in the back that I've put in. And I've talked it through in various different ways. I've shown you different ways of answering this. I've talked about the logic that underlies this. And I've really gone into depth about the philosophy of what is happening in these changes in ownership questions. If you have time to look at that in the back, then that will really increase your understanding of this difficult subject. Okay? Well, fundamentally, when it comes down to it in the exam, the main thing is that you can do these two questions if they come up. So in summary, one last time, toy. Our ownership percentage goes up, the NCI goes down. So you work out how much of the NCI is transferred by the NCI to us. If they transfer 5% of 25%, then they transfer a fifth. If they transfer 10% of 30%, then they transfer a third. If they transfer 2% of 10%, then they transfer a fifth. If they transfer 5% of 35%, then they transfer a seventh. That is how it is done when our ownership goes up. When our ownership goes down, however, you don't look at these ratios. If our ownership goes down, then transferred from us to them is that percentage of the whole business. So if we go down from 90% to 80%, we transfer 10% of the whole business. If we go down from 80% down to 60%, we transfer 20% of the whole business. If we go down from 95% down to 55%, then we transfer 40% of the whole business. Enough said. I'm starting to drive myself completely crazy with this. Let's have a look at the last question. Right. Well, thank goodness the last one is nice and simple and makes perfect sense and is totally non-contentious. Could I even say it's easy? Well, it's certainly easy compared to the previous two. In ROC, we lose control and therefore we have a subsidiary disposal. The thing is, though, that when you have a question like ROC, what often happens is you sell a subsidiary, but you end up keeping influence. And if you keep influence, you end up with an associate. And it ends up with a little bit of messing around, which is a little awkward, but not impossible. And I really like ROC. I think it's a great question. Have a look at the answer with me, and then we're done. So it's going to be quite different to the other, three. A bit more like top, I suppose. A bit more like top. In top, you have subsidiary acquisition, and in ROC, you have subsidiary disposal. Toy and love, they're kind of, very similar. But top and ROC, well, they're kind of similar with each other as well. Top, subsidiary acquisition. ROC, subsidiary disposal. Let's have a look. At the year start, ROC acquired 60% of Star for 360 million. Star has identifiable net assets with a fair value of 400 million at acquisition, and fair value of the NCI was 200 million at that point. Rage has the policy of valuing the NCI at the fair value of the identifiable net assets, but on this occasion it chooses to recognise NCI at fair value. Now, it's a bit naughty of me to put this into the question, I do confess, but it's cute. It's cute. Rage has the policy of valuing NCI at the fair value of identifiable net assets. In other words, Rage has the policy of partial goodwill. Rage has the policy of valuing the NCI at the fair value of identifiable net assets, just net assets, and therefore has the policy of ignoring NCI ownership of goodwill, and therefore has the policy of doing partial goodwill. But on this occasion, it chooses to recognise NCI at fair value. In other words, usually it does partial goodwill, but on this occasion it's going to do full goodwill. What? I accept it's a little bit of a sneaky thing to put into a basic question, but it's absolutely true that this is permissible by IFRS 3. IFRS 3 actually says there is no such thing as a policy for goodwill. You can do partial goodwill, or you can do full goodwill. You could do full goodwill, or you can do partial goodwill. But you can do it on a transaction-by-transaction basis. So you can have two subs bought on one day. One you do partial goodwill, the other one you do full goodwill, if you feel like it. It is complete madness. It is absolutely bonkers and completely permissible by IFRS 3. IFRS 3 is obviously wrong. It clearly is completely internally inconsistent, but it is permissible. So they've taken advantage. Normally they do partial goodwill, but on this occasion they're going to do full goodwill. Yeah, whatever. Okay, so they're going to do full goodwill. At the year end, Rock sells 15% of the 60%, and that will take you down from 60% down to 45%. Now 45% is below the threshold for control, and therefore we're going to lose control of the subsidiary. If you lose control of the subsidiary, then control of all the assets and liabilities walk out. All those assets just walk out the door. They're all gone. All right? You might continue to have some ownership of them, but you've lost control. You can't push them around. You can't say, that machine, I want it mending. That machine, I want it throwing away. You can't say that anymore. So effectively, all these assets and liabilities are just walking out. Okay. So you've lost control of the subsidiary, so there's a subsidiary disposal. There is a subsidiary disposal, but you retain 45%. Let's see if it gives us an influence. At the year end, Rock sells 15% of Star for 150 million and loses control, but retains influence through its remaining 45% ownership. The fair value of the associate retained is measured at 420. And that gives us the rather tricky idea of, a deemed acquisition. From the parental point of view, first of all, the parent has 60% ownership, and then the parent sells 15% of the shares, and it still has 45% of the shares. And all that is fine from the parent point of view. But from the point of view of the group, they have to have a subsidiary disposal because we've lost control. But they actually also have to have a sub-acquisition. So what we are deemed to have done is to have sold the whole sub, completely sold the sub, and bought back an associate. Now, it is true that we have lost control of the subsidiary, but it's not true that we've sold the 45%. But we're going to have to deem it in order to give us a full disposal. So when we actually sell the 15%, we're deemed to have sold the 45% and bought it back. Sold the 45% and bought it back. Okay? We're deemed to have sold the whole 60 and bought back 45. Okay? The fair value of the associate retained is measured at 420 million. At the year end, Star had identifiable net assets of 430 million. The growth of 30 million had been reported through the income statement. Profit on disposal to be recognised in the income statement. Well, I think this is, sounds a bit techy, but when it comes to actually learning it, I think it's all right, honestly. The profit on disposal is accommodated by the following working, which, although it's a bit weird, it does make sense. You've got actual sale proceeds and what are called deemed sale proceeds. The actual sale proceeds represents the 15%. And the 15% really was sold. But the thing is about selling that 15% is it lost us control. And therefore, if you lose control, you're deemed to have sold the whole sub. You're deemed to have sold the whole sub and not just the 15%. So you're deemed to have sold the 45% as well. And then you're deemed to buy it back. But not only that, you also got to de-recognise the non-controlling interest. You can't lose control and keep your non-controlling interest, can you? So when you lose control, you have deemed sale proceeds for the remainder, and you de-recognise the NCI, which is 40%. And if you look, this rather cutely actually adds up
to 100%. You see that? So you've got 100% at the top of the calculation there, and then you've got 100% of the subsidiary at the bottom. And 100% of the subsidiary is all of the net assets and all of the goodwill. And that's going to give you the profit on disposal. Now, in real life, of course, when you make this disposal of 15%, it would be 12 months after the actual acquisition. And of course, in real life, you would calculate the goodwill at acquisition. But this isn't real life, and therefore we're going to have to calculate the figure now. So here we go, we're going to calculate the goodwill. The original goodwill, you know, at acquisition. The fair value of consideration is compared to the fair value of the NCI and the fair value of the net assets to give you the original goodwill at acquisition. So where are we now? The fair value of the consideration at acquisition was 360, and that was representative of a 60% ownership. So there must have been 40% in the NCI. The NCI was 200, giving us a combined fair value of the entire entity of 560. The net assets were 400 at acquisition. So it's 160. So 160 is the goodwill at acquisition, but it's also the goodwill 12 months later, because goodwill stays still. So this is the goodwill at acquisition, but it's also the goodwill at disposal 12 months later. So it's the first of the figures we can drop into the schedule above. So let's drop it into the schedule above. The goodwill is 160. We're also going to de-recognise all of the net assets, but clearly we're going to de-recognise the net assets at disposal. And the net assets at disposal are going to be more than the 400, presumably. At the year end, Star had identifiable net assets of 430. That's 430. I think I'll do NCI last. Working right up to the top, the figure that actually generated this disposal was the actual sale proceeds for the 15%. At the year end, Rock sells 15% of Star for 150 and loses control. That's the 150 that kind of dominates this story. But it's actually smaller than the deemed sale proceeds. Now, I know it's not true. I know we didn't sell the associate and buy it back. But in order to completely get rid of the 60%, we have to deem ourselves not only to have sold the 15%, but also to have sold the 45%. I know it's a bit awkward, I know it's not actually true, but it's just deemed sale proceeds. We are deemed to have sold the whole sub and bought back an associate. So what is the fair value of the associate that we would recognise at acquisition? The fair value of the associate is 420, you got that? So that would be the acquisition price of the associate, and therefore we're deemed to have sold it at 420 and bought it back at 420. We're deemed to have sold it at 420 and bought it back at 420. And of course, from our point of view, we're concentrating on the sale. So we're deemed to have sold it for 420 and lost control and therefore de-recognising the NCI. Roll forward. The acquisition NCI was 200. And the growth is going to be 40% of the growth in the entity, which was 30. 40% of 30 is 12, isn't it? So the growth in the NCI is 12. So NCI starts at 200, adds on 12, 212. And therefore the profit on disposal to be recognised in the income statement is 150 plus 420 plus 212 minus 430 minus 160. 192 would be the profit on disposal to be recognised in the group income statement. Fantastic. There you go. There's the 4 changes in ownership questions. Please make sure you practice those. As usual, practice them until you feel confident in this subject. The examiner has said that it is going to form a regular part of his examinations in question 1. Fair enough, really. Changes in ownership, as you can see, is an awkward and contentious area, so it's not unreasonable that you'd be expecting maybe one of these stories. Just maybe one. Maybe top, maybe love, maybe the one that we've just done, maybe rock. But just one of these roughly every year, I would say. Possibly one in every exam. But certainly you'd be expecting one of these stories every 12 months. All right. Good luck, guys, with your practice on that, and I'll see you in the next chapter.